Glenn, the last time we spoke on television, it was almost a year ago. You'll remember this. You told me the world is okay. How would you describe the world right now?
Well, it is not quite as okay as it was. If I was asked to think about a word to describe the world today, I'd have to use the word challenged, but I'd also have a ... and a but after that. The challenge is obvious. We have a health crisis that we have not seen in modern time. We have a shutdown of a global economy. We have massive unemployment, shutdown of small business, mental health issues that are probably on the horizon, and there's not an end in sight, although certainly there's many efforts being made, whether it be in the drug therapy side or in the vaccine side. And so we have a humanitarian crisis, and yet I have to say that there's a but there, because as an investor, this dislocation, I think, is creating very, very interesting opportunities. And ultimately, I believe that if we have therapies or vaccines that can solve this, that we will return to normal. I happen to think that that road back, I think the market shares the view as witnessed by the last week, 10 days of incremental volatility bumping along these levels with a little bit more downward pressure. I think that if you believe that in the next couple of years there will be a return to normal, then I think there's actually some very good value across the board, although you have to be incredibly patient and incredibly selective.
I want to hear more about that, let's call it glass half full thinking. But first, let me start with this. And I'm going to go back to the okay part. When the world was okay, Oak Hill made investments with the expectation that for the most part, the world would continue to be okay. Now that the world is challenged, even if there's a but ... have any of the decisions you made back then come back, if you will, to haunt you in any way?
So I've always been a believer that no matter what environment you're in, you want to buy quality companies in good industries with good management teams. And I will tell you that I'd be a fool if I said that we have not taken any mark-to-market hits, if you will, or assets that have gone down in value on a mark-to-market basis over the last year since that discussion. Certainly, we had a great year last year, I'd say, but certainly since March 1, it's not been as good. But I will tell you that I've always believed if you buy quality, then that ultimately that quality comes back. And the question in what we do is whether or not there's permanent impairment, and do we have the ability to play offense, or are we playing more defense now? And fortunately, we're more on the offense, and I would just qualify a little bit, and we'll come back in a minute, on this glass half full. It's a measured glass. There's lots of places where the glass is unquestionably closer to empty, and certainly what's happened in the energy sector would be one of those sectors. But to answer your question, our experience has shown that if you buy quality, you do well. If you looked at our portfolio back in the spring of 2008, and you went on vacation for a couple of years and came back at the end of 2010, we were up 35% in a lot of our portfolios. And I think you'd say, geez, I guess nothing happened, and yet we all know a lot happened. And so I believe if you own quality and you're in the right place in the capital structure, you can make money. And again, we were quite cautious with our higher return distressed capital for most of the last couple of years because we didn't see wholesale dislocation. And now that we're seeing it, now that we've seen it, now that we're living it, we're being much more aggressive, if you will, in seizing some spots.
Credit investors are fundamentally value people, right? You are happiest when things are really cheap. A month ago, they were really cheap. Are they cheap enough now?
Well, they're not as cheap as they were, and certainly the combination of the equity markets bouncing, which I think in great part has come from a combination of the Fed aggressive buying, the stimulus, and obviously in some places the flattening and downturn in the curve, that has taken out a lot of the quality end of the trade, and I can tell you that we and certainly many others were very active in March and into early April as aggressive buyers on the quality side.
Can I ask you?
And there was the opportunity to make 10 plus points.
Can I ask you, since you just mentioned?
And we've actually used the opportunity over the last couple of weeks to sell some of those positions that we bought in mid-March and into late March.
So can we scale that? Can you tell me how much you were able to put to work in the most vicious parts of the downturn and how much you've been able to get back?
So what I will tell you is that we have purchased, since March 1st, we have purchased over $3 billion of investments. We sold $1 billion plus, so 3 plus minus 1 plus equals about $2 billion of net purchases that we've made since March 1st as a firm.
Boy, that is busy. Now, as we both know, the Federal Reserve is going to buy hundreds of billions of dollars in corporate bonds and even dip its toe into the junk market. Incredible. Is the market pricing that Fed bid appropriately, Glenn? Because there's an awful lot of enthusiasm for investment grade, or is it getting ahead of itself?
So I think that the market has actually done what you'd expect it to do, and what I like to highlight for our investors is there's been a massive differentiation in performance in the higher quality portion. So the high yield market today is down about 10% year to date. It was down 20 at the lows. If we look at the separation of double B in high yield, that's only down 6. Single B is down 11. And the triple C portion is down 21%. And the same statistics are basically the same for the leveraged loan market. And so what I would say is that the market has priced up the quality end of the leveraged finance market and ultimately left the distressed opportunity investors like ourselves to seize upon those names that are more challenged and those that have, in most cases, more COVID-related exposure to generate higher returns.
So where then do you think you can find those double-digit returns? Because I know that's what you're looking for, and in fact, not just double digits, you'd like them to be north of 20. Where do you think you're going to find them with the confidence, right, that the cash flows supporting those credits are going to be relatively intact a year from now or 2 years from now?
So what I would say is that the greatest opportunity that we see is in rescue financing or provision of liquidity to companies on a private or in some cases a syndicated basis, where companies never modeled in a global shutdown, never modeled in. They don't teach you in business school to run a case with zero revenue for a couple of quarters and then a slow recovery, and that there are fundamentally some very good businesses that just have a liquidity shortfall. And so we've been having many discussions with relationships of ours, companies we know well, sponsors we know well,
now,
to offer them a range of financing options from what we'll call safety financing options to more rescue type style, and those investments can come in the form of senior debt, or they can come in the form of convertible debt, or they can come in the form of debt with warrants. And we have made a number of investments in the last few weeks and have many proposals outstanding. We made a $400 million proposal on a mortgage REIT that needed incremental financing to weather its way through the storm. We have a number of different proposals in front of companies. And I believe that ultimately, if you have a good company, the most important thing is survival. The most important thing to survival is liquidity.
Glenn, I want to jump in. We only have a short moment left, but with this quick question, there's so much money available for credit opportunities and so much more being raised. Do you have any sense, dollar number, for how much is going to be mobilized in this bottom part of the cycle?
You know, there's lots to talk about, tens and tens of billions. I certainly read many of those headlines on Bloomberg headlines. And our view is that every one of those investors and our peers and competitors have a strategy, and what makes them gives them their competitive advantage. What I will just do is speak to ourselves and say that we've been doing this for 30 plus years, have deep industry knowledge, relationships, et cetera.
I have
and so we think we
jump.
can find many opportunities.